Welcome to Swing Trade Pro, a three-part educational offering from Pivot Boss with Frank Ochoa. This is part 3 of Swing Trade Pro, Trade and Risk Management. While traders are usually more eager to learn about the next sizzling setup or indicator, true professionals know that the longevity in trading comes from managing the trade and managing risk. In this section, we'll be delving deep into trade management, from forecasting accurate swing targets to scaling and trailing techniques. Of course, we'll also cover some of the best risk management approaches that you can use in your trading immediately. By far, mastering the techniques in this course will do more for your trading than anything else combined. So let's go ahead and get started with part 3, Trade and Risk Management. The first section in Trade and Risk Management is forecasting accurate targets. Of course, we're going to look at everything from forecasting targets to scaling and trailing opportunities to ADR stops. I'm going to reveal the free trade technique, and then we're going to talk about putting it together and combining the various targets with trailing stops, scaling methods, etc. But basically, trade management involves everything, every aspect that goes into managing a trade, from targets, trailing stops, lost stops, scaling techniques, and more. Every single aspect has its own nuances, its own techniques, its own concepts, and we're going to look at every single one of those in great detail. After that, you'll have a very solid foundation of how to plan a trade management approach for your style of trading. In the first section, forecasting accurate targets, we're going to look at how I approach the market with price-based targets. The Pivot Boss approach to taking profits relies upon forecasting targets based on average price movement and utilizing actual profit targets. That's the number one thing here. For me, I had good trading results when I used trailing profit stops. But when I moved my philosophy to a profit target type of philosophy, where I used the majority of my trades had profit targets, that's when my trading really went up, because I was actually able to forecast high probability targets and play to those targets effectively while getting great trade location. And then after the trade was done, I was able to go on to the next setup and employ the same type of rules. So playing to profit target is going to be a very solid approach that we're going to be using here, but I'm also going to show you how I incorporate trailing profit stops when the time calls for it. Average price movement provides a price-based method to forecasting targets. That's important. Price is king. So when you're able to forecast anything, whether it's support resistance lines, targets, stops, anything based on actual price, you're going to likely have better and more reliable numbers to work with. Trading to high probability targets yields consistent results, and that is what happened in my real life trading. When I was able to identify high probability targets using the ADR method, what's now known as the ADR method, I was able to consistently book profits, and that is very important. Of course, using profit targets and using price-based stops based on ADR allows you to more easily incorporate risk management measures, which we'll talk about in the second half of this course. Trading to profit targets is the Pivot Boss preferred approach, but we'll be looking at how to trail price as well and scale at various points in the chart. So let's talk about pro-style techniques for forecasting targets. The two styles that we're going to talk about, basically they all revolve around the same method, but we're going to be looking at swing targets and weekly targets. And these are all based on average daily range, or the ADR method. What's great about the swing targets is, depending upon your expected trade duration, you're able to adjust the targets accordingly. So if you're looking for a 3-day swing trade move, you can get the targets for a 3-day bull or bear zone. You can also look for 5-day targets, 7-day targets, 10-day targets, 15-day targets, whatever the duration is, or the expected duration of the trade you want to trade, um, you can basically tailor the swing targets to those expectations. What I love about both of these approaches is that you'll notice that the bullet points are going to be the same for a lot of these that we talk about, because everything I teach is simple and effective. Everything that I teach is price based, which means they self-adjust to current volatility. When you have, the summer doldrums, you're going to have different targets that are projected that are likely going to be closer than normal because the volatility during that period of time is much lower. If we're talking about the beginning of the year where volatility picks up, or maybe in the fall when volatility picks up, the targets will be farther apart, and justifiably so, because trading activity will have picked up. And that's what I love about price-based indicators or price-based approaches, is that it self-adjusts to current market behavior and volatility. The thing about average ADR weekly targets is that you're able to identify targets for the week using the same type of concepts. So we're going to be looking at both of these in good detail right now, and let's go ahead and get started with ADR swing targets. ADR swing targets basically shows that you're able to forecast high probability targets based on average price movement. When you identify average price movement, you're basically using average daily range, right? That's average price movement. But you can also do so on a multiple day basis as well. So if you're looking at a 2 or 3 or 4 or 5 day multiple day range, then you're able to forecast targets 2, 3, 4, or 5 days into the future, given average price movement. And that's important. When we're looking at ADR swing targets, what was very important in my research was that the probabilities were consistent depending upon how far the target was away from current price. So if we're looking at certain targets, which we'll see here very shortly, some of these targets have an expectancy or probability rate of greater than 70%. If you go down into real-time or intraday trading charts, some of these were as high as 80 to 90% likely to be reached, and that's very important. But before we get started with ADR swing targets, let's first talk about average daily range and some of the other components that go into building an ADR swing target. So what is the ADR method? The ADR method is a simple yet powerful approach that is used for forecasting targets using average price range. And this can be done in any time frame. And that's important because I really like to teach concepts that scale across any time frame or any style of trading. So if you trade minute bars or if you trade weekly or monthly bars, you can use these types of targets, and that's important. What's great about the ADR method is it helps you forecast targets with a very high degree of accuracy. Again, the swing targets, some of these targets have a 70% potential of being reached. That's huge. The other thing is that if you're going down into a real-time time frame, some of these have an 80 or 90% chance of being reached, and that's very, very powerful. Others will only be reached 45 to 50% of the time, but at least you know this ahead of time and you can scale appropriately or only leave smaller position size to those targets. What's great about the ADR method is that it auto-adjusts to the current market volatility and behavior. Like I mentioned before, if you have quiet period of trading, like during the summer or maybe the holiday trading season, the ADR will self-adjust and the targets or stops that you use will be based on a lower volatility. That's very, very powerful stuff. The other thing is that this is simple, effective, it works. You can learn it very, very quickly and begin incorporating it immediately. If you are not currently familiar with the ADR method, then there are real-time and swing editions available at the Pivot Boss shop, and these two DVDs, one for real-time, one for swing trading, teach the entire methodology. What we're going to use here are the base calculations and also some newer concepts to help you identify some of these targets as well. So I'm throwing in a little bit of old, a little bit of new, but if you want the full method, you can also um, grab those additional resources as well. So why should you use ADR targets? Basically, average daily range has been used by professionals for years, and it's because average daily range provides a price-based approach that relies on current price behavior. What's great about ADR targets and why you should use them is because they provide simple price-based approaches that incorporates recent price behavior. They self-adjust to current volatility. They help provide reasonable price expectations for the upcoming period of time. And that's important because a lot of times novice traders have big expectations for their trades. Every time they enter a trade, they believe they're going to hit a home run. I know I did when I first started trading, but that's simply not the case. Can you imagine a professional baseball player going up to the plate and every time expecting to hit a home run? That's just not the case. Instead, a better approach to baseball is to always try to hit singles and doubles. Just get on base, because getting on base leads to runs. And that's just like trading. If you consistently hit to profit targets, like base hits, then you're consistently booking profits, which is like runs. Every once in a while, when you hit a single, it'll actually turn out to be a huge home run. And that's where the windfall profits come in, and you can adjust accordingly. But what's great about the method is it provides reasonable expectations for where price is likely headed, and that's huge. The other thing, the method or targets allows you to easily forecast bull and bear targets regardless of time frame. So there's a lot of versatility here. If you use, like I said, 60-minute charts, or if you use 1-minute charts or weekly time frame, you can still use this approach. And of course, allows you to anticipate market behavior, including breakouts and range markets. That's the other thing about ADR, or average price movement, is that during expansion and compression phases, indicators like ADR can help you identify when to expect big moves or quiet markets. So there's a lot of volatility to this approach, or versatility to this approach. So what is ADR? ADR is average daily range. Average daily range is calculated by averaging the sum of the daily ranges over a given period of time. So daily range refers to the high minus the low of a day, including the extended hours trading. ADR refers to averaging the daily ranges over a string of days. It's just like a moving average. So the ADR method primarily uses a 5 or 10 period ADR calculation, which is similar to a 5-period moving average or a 10-period moving average. ATR, average true range, can be substituted for ADR, but just know that ATR includes gap data in its value calculation, which means that an ATR value will almost always be higher than an ADR value. And that means the targets will be a little farther away. And that also means if they're a little farther away, you're not going to reach them as often. So let's talk about calculating the ADR through this graphic here. What you see is days 1, 2, 3, 4, and 5, and these are daily bars. Day 1 has a range of 44.25. From the high minus the low is 44.25. Day 2, 25.75. Day 3, 23.75, and so forth. When you have 5 days in a row and you take the 5-period ADR, you're basically averaging the 5 days of price range. And when you average the 5-period price range like that, it gives you a value. So after these 5 days, you average them out, it gives you an ADR, a 5-period ADR of 29.45. And what that does, that 29.45 allows you to forecast what the upcoming day's potential price range could be on average. That means if the upcoming day trades on average what it had been trading in the last 5 days, it will trade on or around 25.45 points, or 29.45 points. If you look at actually what happened, day 6, that day's price range turned out to be 32.25 points. So if you were able to identify the high or low for the day, here's the high, and project lower by 29.45 points, you would have hit a target that was only less than 3 points away from the day's low, and you would have netted a very nice gain. So that's how you calculate ADR. You look at the daily ranges over a string of data, average them out. And once you have the average,